Welcome to Talk Tickers, where we break down the latest earnings calls for experienced investors. Today, we're digging into Donaldson Company's Q1 fiscal 2026 results.
And wow, did the market like what it heard? The stock absolutely surged, jumping almost 7.5% right on earnings day. So what exactly was behind that big pop? That's the key question, right? We're going to dive into the numbers, unpack the story they're telling, and figure out what it all means for the stock from here on out.
Okay, first up, let's look at the headline numbers. And really, it was a strong beat across the board. Donaldson came out of the gate swinging to start their fiscal year.
So as you can see here, adjusted EPS came in at 94 cents. That beat what the street was looking for by a couple of pennies. And on the revenue side, they pulled in $935.4 million, which was a solid $12 million ahead of what everyone was expecting. Just a really clean beat on both fronts.
But here's what really gets interesting. Look at the operating leverage here. You've got sales growing just under 4%, but look at the earnings. Adjusted EPS jumped a whopping 13.3%. That's the magic right there. Turning a little bit of sales growth into a whole lot of profit. You know the market absolutely loves to see that kind of efficiency.
All right, so where did all of this outperformance actually come from? Well, it's really a story of a few key parts of the business firing on all cylinders, and that strength was more than enough to overcome weakness in other areas.
Now, mobile solutions is still their biggest piece of the pie, no doubt about it, making up almost 2/3 of sales. But the real story, the growth engine, wasn't just in one place. It was these specific pockets of strength across the whole company that really carried the day and made up for some of the softer spots.
And this slide just lays it out perfectly, doesn't it? On one side, you have your growth engines. Think about the high-margin aftermarket business. That's a recurring revenue stream. Then you've got the whole data center and AI build-out, which is a huge tailwind. And on top of that, life sciences is really starting to cook. All that good stuff was more than enough to offset the headwinds you see on the other side. You know, the usual suspects like weaker global truck production and a bit of a slowdown in defense.
And management was all over this on the call. The CEO, Todd Carpenter, kept coming back to their core strategy. He talked about that classic razor and blade model. You sell the main unit, the razor, and then you get that steady, recurring revenue from the replacement parts, the blades, for years. And it's working. Aftermarket sales were up a really strong 7%.
But listen, this is a super important point. It wasn't just about selling more stuff. It was about how profitable they were. They hit a record for a first quarter with a 15.5% adjusted operating margin. That's a huge deal. It was all about that leverage we talked about, plus just being really smart and disciplined with their costs. Okay, so let's pull back a bit and look at the bigger picture here. Because when you put Donaldson's performance up against its peers, it looks even better. I mean, just look at the last year. DCI is up about 26%. Compare that to the broader industrial sector, the XLI ETF, which is up only 10%. So Donaldson is just crushing it. And this isn't just a one-time thing, right? You can see it's been a consistent trend of outperformance.
And what this performance really shows is a change in the story, a shift in how the market is thinking about this company. People are starting to see Donaldson not just as another old-school industrial company that goes up and down with the economy. Instead, they're seeing it for what it is, a high-return filtration specialist with growth drivers that are going to be around for a long, long time. All right, so where do we go from here? We've crunched the numbers, we've listened to what management had to say, so here's our call on the stock.
Our thinking here really boils down to 3 key things. First, the margin story is legit. Management actually raised their full-year guidance, so they're confident this profitability isn't a fluke. Second, those growth engines we talked about, data centers, life sciences, those aren't going away. They're long-term trends that can power through any short-term economic bumps. And third, the stock is already being rewarded for this. That re-rating we mentioned, it's happening right now.
So, putting it all together, we're slopping an outperform rating on this one. We fully expect the stock to keep beating its industrial peers as more and more investors catch on to the fact that this isn't just a cyclical play, it's a high-quality compounder.
And hey, if you want a really spicy take, think about this for a second. That life sciences business, right now it's kind of a bunch of acquisitions they've put together. But what happens when that becomes a single high-growth machine? The whole story could change again. The market might start valuing it not like an industrial company, but like a medtech company or a water tech company. And if that happens, we're talking about a whole different level of valuation and a lot more upside from here.
And that's our breakdown of a really impressive quarter from Donaldson. Thanks for joining us. Just a reminder, of course, this is not financial advice.